Right now, as you're watching this video, something strange is happening in the global financial system. Markets look calm on the surface. Headlines talk about soft landings, policy pivots, and economic resilience. But underneath that calm exterior, the system is under pressure. Political pressure, monetary pressure, and institutional pressure, all at the same time, and quietly, almost invisibly. Bitcoin is reacting. Bitcoin doesn't move randomly. It reacts to fear, not panic, not hype. Fear. Today, even while you're busy scrolling your phone, governments are running historic deficits, central banks are boxed in by debt, and trust in institutions is eroding faster than at any point since the global financial crisis. And every single time this happens, every time the system looks unstable, Bitcoin rises. Welcome to The Finance Historian. If you're new here, this channel exists for one purpose: to connect what's happening right now to what has already happened in history, so you can see patterns before most people do. If that sounds valuable, take 1 second to like this video and subscribe. It helps this channel more than you realize, and it keeps you ahead of the curve. Now let's get into it. Most people think Bitcoin moves because of hype. They think it's driven by tweets, influencers, ETFs, or random speculation. That's surface level thinking. When you zoom out, and I mean really zoom out, Bitcoin behaves less like a tech stock and more like a stress indicator for the global financial system. It doesn't rise because everything is fine. It rises when confidence breaks. And to understand why, we need to do something most financial commentary never does. We need to go back. Every major shift in money throughout history has been born from instability. Not innovation alone, not progress alone, fear. When the Roman Republic collapsed into empire, trust in bronze coinage evaporated. Gold and silver became power. When medieval Europe fractured under endless wars and debasement, merchants created private banking systems to escape unstable rulers. When kings abused paper money, people hoarded hard assets. And when central banks broke the global monetary system in 1971, when the dollar was severed from gold, something fundamental changed. Money stopped being anchored to reality. Since that moment, every financial crisis has been solved the same way. More debt, more money printing, more promises. And every time, people looked for an exit. Gold was the traditional exit. Bitcoin is the modern one. Bitcoin didn't appear during economic optimism. It was created in January 2009, directly after the worst financial collapse since the Great Depression. The very first Bitcoin block, the Genesis block, contains a message embedded in its code. The Times, 03, Jan 2009. Chancellor on brink of second bailout for banks. That wasn't an accident. That wasn't decoration. That was a statement. Bitcoin was created as a response to institutional failure, to bailouts, money printing, and moral hazard. From day one, Bitcoin has been a reaction, not a speculation. And that reaction repeats every time the system shows cracks. Here's the key idea most people miss. Bitcoin doesn't measure optimism. It measures distrust. Distrust in governments, central banks, monetary policy, political stability, long-term purchasing power. Whenever trust in those things declines, Bitcoin rises. Not immediately, not predictably, but consistently. Let's look at the pattern. Crisis 1, the Eurozone debt crisis, 2010-2012. During the European sovereign debt crisis, countries like Greece, Spain, and Italy faced potential default. Banks froze withdrawals, capital controls were imposed, people were told their savings were safe. Bitcoin went from essentially zero to over $1,000 for the first time. Why? Because for the first time in modern history, millions of people saw that bank money is not your money. Fear entered the system. Bitcoin responded. Crisis 2, Cyprus bank seizures, 2013. In Cyprus, depositors woke up to find their bank accounts partially confiscated to stabilize the system. No vote, no warning. Bitcoin surged over 400% that year. Not because of hype, because confiscation destroys trust. Crisis 3, China capital controls, 2015-2017. As China tightened capital controls and devalued the yuan, Chinese investors rushed into Bitcoin as a way to escape currency risk. Bitcoin went from under $300 to nearly $20,000. Fear again, different country, same reaction. Crisis 4, COVID and unlimited money, 2020. In 2020, the world shut down. Governments printed trillions in months. The Federal Reserve expanded its balance sheet faster than at any point in history. At first, Bitcoin crashed because everything crashed. Then it exploded from $4,000 to over $60,000. Why? Because people realized something terrifying. There was no plan, only printing. Bitcoin is not anti-government. It's anti-fragility. This is important. Bitcoin isn't rising because people hate governments. It rises because systems built on trust collapse when trust is abused. Bitcoin doesn't require central banks, bailouts, political stability, credibility. It only requires math. That's why it performs best when institutions look weakest. Today, the system is under more strain than at any point since World War II. Global debt is at record levels. Central banks are trapped between inflation and collapse. Political polarization is accelerating. Trust in institutions is collapsing. Currency weaponization is rising. And Bitcoin is responding again. But this time, something is different. Institutions are buying it. ETFs exist. Corporations hold it. Governments are discussing it. Bitcoin is no longer a fringe reaction. It's becoming a structural hedge. To understand why Bitcoin rises when the system looks unstable, you need to understand something deeply uncomfortable about money. Money is not built on value. Money is built on belief. Belief that your currency will buy something tomorrow. Your bank will give you your money back. Your government will honor its promises. Your central bank knows what it's doing. As long as belief holds, the system functions. When belief cracks, everything changes. And here's the critical insight most people miss. Markets don't collapse first. Trust collapses first. Prices are the lagging indicator. Bitcoin is one of the earliest ones. Every financial system looks strongest right before it weakens. Rome looked stable right before debasement destroyed the denarius. Britain looked unshakable right before the pound lost reserve status. The US looked dominant right before Nixon closed the gold window in 1971. In each case, the public didn't lose trust all at once. Trust eroded quietly. Small policy changes, temporary emergency measures, unprecedented decisions that were never reversed. Sound familiar? Central banks depend on one thing above all else: credibility. They don't control money because of force. They control money because people believe their policies will work. But here's the trap. Once debt reaches a certain size, central banks lose real choice. Raise rates. Debt becomes unpayable. Lower rates. Currency loses purchasing power. This is not theory. This is math. And when people sense that central banks are trapped, confidence fades. Bitcoin doesn't need to outperform everything. It just needs to not be trapped. Now, why does gold work and why Bitcoin is different? For thousands of years, gold was the escape valve. Not because it was perfect, but because no government could create it. When empires debased currency, gold preserved value, but gold had weaknesses. Hard to transport, easy to confiscate, difficult to divide, dependent on physical control. Bitcoin solves those weaknesses. It is borderless, scarce, portable, permissionless, censorship resistant. That's why it behaves like digital gold under stress. Bitcoin doesn't need collapse, only doubt. Here's a key misunderstanding. Bitcoin does not require full system collapse to rise. It only needs increasing doubt. Doubt that inflation will be controlled, debt will be repaid. Honestly, rules won't change suddenly. Savings won't be diluted. Every time that doubt grows, Bitcoin absorbs it. That's why Bitcoin often rises before recessions, before crises, and before headlines turn dark. It's not reacting to events, it's reacting to conditions. Pay close attention to this. Whenever markets expect the Federal Reserve to pivot, Bitcoin tends to rise. Why? Because a pivot usually means growth is breaking. Like this. Debt stress is rising. Something is about to crack. Lower rates don't signal strength. They signal fragility. Bitcoin understands that. In recent years, banks collapsed. Emergency facilities were quietly reopened. Trillions were backstopped overnight. Treasury issuance exploded. Inflation proved persistent. And yet, the messaging stayed calm. Contained, temporary, transitory. Bitcoin didn't believe it. Neither did capital. That's why you saw record ETF inflows, institutional accumulation, long-term holders refusing to sell, supply tightening on exchanges. Fear doesn't always look like panic. Sometimes it looks like quiet preparation. This is not retail-driven anymore. One of the biggest shifts happening right now is this. Bitcoin is no longer driven primarily by retail speculation. It's increasingly driven by asset managers, hedge funds, family offices, institutions hedging systemic risk. These players don't chase memes. They hedge scenarios. And the scenario they're hedging is simple. What if the system doesn't break, but never fully heals? If this perspective is making you rethink what Bitcoin actually represents, pause for 1 second and hit the like button. It tells YouTube this is serious content, not hype, and it helps this channel reach people who are trying to understand the world, not gamble in it. Every financial system rests on one invisible pillar: not money, not interest rates, not even governments. The moment trust cracks, capital starts searching for an exit, and history shows us something uncomfortable. Bitcoin doesn't surge when things are good. Bitcoin surges when trust collapses. Let's rewind. In March 2020, the world shut down. Markets crashed at record speed. Oil futures went negative. People emptied grocery stores like it was the end of days. And what did central banks do? They panicked. The US Federal Reserve printed more money in 3 months than it had printed in the previous decade. Trillions, created instantly. No vote, no public debate, just a few keystrokes. At first, Bitcoin crashed too, and that confused people. See, Bitcoin failed. But then something strange happened. As fear shifted from markets to money itself, Bitcoin reversed, hard, from under $4,000 in March 2020 to over $60,000 a year later. Not because Bitcoin changed, but because the system exposed itself. Bitcoin is not an investment. It's a reaction. This is where most people misunderstand Bitcoin. They treat it like a stock. They ask, is it overvalued? Is it speculative? Is it too volatile? Wrong questions. Bitcoin is not reacting to earnings. It's reacting to instability. Think of Bitcoin like a financial seismograph. It doesn't predict earthquakes. It reacts when the ground shakes. And every time the system shakes, Bitcoin responds. Bitcoin was born in January 2009. Not randomly, not accidentally, right after the global financial system nearly collapsed. And embedded inside Bitcoin's very first block was a message, the Times 03, John 2009, Chancellor on brink of second bailout for banks. That wasn't decoration. That was a statement. Bitcoin wasn't designed to replace cash. It was designed to exist outside bailouts, outside manipulation, outside trust-based systems. Because in 2008, trust was destroyed. Banks gambled. Governments bailed them out. Regular people paid the price. Bitcoin was a response to that injustice. And every crisis since then has reminded the world why it exists. Every crisis follows the same pattern. Watch this carefully. Every time the system faces stress, the response is identical. 1, rates go up, something breaks. 2, markets panic. 3, the Fed steps in. 4, money supply expands. 5, currency weakens. 6, scarce assets rise. Gold, real estate, and now Bitcoin. This is not theory. This is repetition. Central banks are trapped. If they raise rates, debt becomes unpayable. Governments struggle. Markets crash. If they cut rates, inflation rises, currency weakens, purchasing power collapses. There is no clean exit. Every solution creates a new problem. And Bitcoin thrives in this environment because it cannot be printed, it cannot be bailed out, it cannot be manipulated by policy meetings. It doesn't care who's in power. It doesn't care about elections. It doesn't respond to press conferences. It simply exists. If this is making you see Bitcoin differently, not as a hype asset, but as a historical response to instability, then pause for 2 seconds, hit the like button, and subscribe to The Finance Historian. Because what we're doing here isn't price prediction. We're decoding why money behaves the way it does. Here's something rarely discussed. Bitcoin doesn't just react to monetary instability. It reacts to political dysfunction, debt ceiling standoffs, government shutdowns, trade wars, sanctions. Every time political systems prove unreliable, capital looks for neutrality, and Bitcoin is politically neutral. No borders, no allegiance, no favoritism. When governments fight, Bitcoin doesn't pick a side, and that makes it dangerous and valuable. Right now, as you're watching this, global debt is at record levels, trust in institutions is declining, central banks are contradicting themselves, elections are increasing volatility, and currencies are being quietly diluted. Bitcoin doesn't need to win. It just needs the system to continue behaving the way it always has, and history suggests it will. Most people think Bitcoin reacts to the news. That's wrong. Bitcoin reacts to what the news hasn't admitted yet. By the time headlines scream crisis, the real move has often already happened. And that's not magic. It's incentives. Financial systems don't break all at once. They bend first. Stress builds quietly. Liquidity dries up. Banks tighten lending. Bond yields behave strangely. Currency volatility rises. Overnight lending markets twitch. These are not headline events. They are system signals. And Bitcoin traders, from especially large global capital, are watching those signals constantly. Bitcoin is one of the few assets that trades 24/7 globally, outside traditional market hours, without central control. So when pressure builds at 2 a.m. on a Sunday, Bitcoin reacts before CNBC, before politicians, before official statements. Here's a hard truth. Retail waits for certainty. Institutions move on probability. By the time the public feels safe enough to act, the risk has already passed, and the price has already moved. Bitcoin often rises during quiet bond market stress, subtle Fed language shifts, early banking liquidity issues, political uncertainty that hasn't yet exploded, because the people moving capital early don't need permission. They just need asymmetric protection. Stocks hedge earnings, bonds hedge growth, gold hedges inflation, Bitcoin hedges loss of control, the things policymakers don't see coming. The things they deny until they can't. The things they promise won't happen, right before they do. That's why Bitcoin rallies often look irrational in the moment. They're not reacting to what is happening. They're reacting to what might happen if the system keeps going this way. Think about recent bank failures. Notice the pattern. Officials say it's contained. Depositors quietly move funds. Emergency facilities quietly open. Balance sheets quietly expand. No dramatic speeches. No crisis label, but Bitcoin notices. Because Bitcoin doesn't listen to reassurance. It watches flows, and flows reveal fear long before words do. Now this is why Bitcoin is faster than gold now. Gold used to play this role, but gold has friction, storage, transport, settlement delays, market hours. Bitcoin has none of that. When fear spikes, capital can move instantly, across borders, without approval, without custody, risk from intermediaries. That speed matters in modern crises, and the faster the world moves, the more valuable speed becomes. The media always explains Bitcoin backward. After Bitcoin rises, headlines say, Bitcoin surges on optimism, Bitcoin jumps on ETF news, Bitcoin rallies on sentiment shift. But those are explanations after the fact. Bitcoin didn't rise because of optimism. It rose because risk was rising elsewhere. The story is always written backward. Bitcoin moves first, narratives catch up later. Right now, governments are heavily indebted. Central banks are politically pressured. Monetary credibility is fragile. Global trust is fragmented. These are not loud emergencies. They are slow leaks, and Bitcoin doesn't wait for the flood. It reacts to the crack. Every system reveals what it fears by what it tries to control, and few things have triggered more confusion, hostility, and contradiction from governments than Bitcoin. Not because Bitcoin is violent, not because it's chaotic, but because it removes monopoly power over money. This is why governments tolerate almost everything. Except monetary independence, governments allow political opposition, corporate monopolies, massive inequality. But money? Money is sacred territory. Why? Because control of money equals control of taxation, control of debt, control of incentives, control of survival during crises. Bitcoin threatens none of this directly. What it threatens is exclusivity. For the first time in history, individuals can opt into a monetary system without permission, without geography, without trust in leadership. That's unprecedented. At first, governments ignored Bitcoin. Then they mocked it, then they attacked it, then they regulated it, and that sequence tells you everything. Regulation isn't suppression, it's recognition. You don't regulate irrelevant things, you regulate what refuses to disappear. Every licensing framework, ETF approval, tax rule, or compliance structure sends the same message. Bitcoin is not going away. And every attempt to control it, ironically, strengthens its legitimacy. Some countries tried outright bans. What happened? Bitcoin activity didn't vanish, it relocated, it adapted, it decentralized further, because Bitcoin is software, and software is harder to ban than behavior. The more pressure applied, the more distributed it becomes. Power doesn't crush Bitcoin, it fragments itself trying. Bitcoin thrives on distrust, not adoption. This part matters. Bitcoin doesn't need mass enthusiasm, universal belief, everyone to understand it. It only needs continued distrust in systems. As long as debt grows faster than economies, money is created faster than value. Institutions contradict themselves. Promises require future sacrifice. Bitcoin remains relevant, not popular, relevant. CBDCs are often presented as innovation, but to many people, they signal something else. Programmable money, increased surveillance, reduced autonomy. Whether those fears are justified or not doesn't matter. Perception drives behavior. And every discussion about digital control makes Bitcoin's neutrality more attractive. Bitcoin doesn't watch you. Bitcoin doesn't freeze accounts. Bitcoin doesn't expire. That contrast matters during unstable times. Right now, trust is thinning, not collapsing, thinning. And that's the most dangerous phase, because systems don't fail when everyone panics. They fail when everyone pretends everything is fine. Bitcoin doesn't wait for permission to react. It responds to that quiet erosion. By now, one thing should be obvious. Bitcoin doesn't rise because people are greedy. Bitcoin rises because people are cautious. It rises when confidence erodes, quietly, gradually, then suddenly. Every time trust in institutions weakens, Bitcoin becomes more visible. Not louder, more necessary. History doesn't repeat, but it rhymes. Empires fall not from invasion, but from debt overload, currency debasement, political paralysis, loss of public trust. From Rome to Weimar to modern fiat systems, the story is the same. Money breaks before society admits it. Bitcoin exists in that gap, between denial and realization. Bitcoin doesn't attack the system, it reflects it. When policy is disciplined, Bitcoin looks boring. When leadership is credible, Bitcoin feels unnecessary. But when decisions become reactive, when promises require printing, when stability depends on confidence alone, Bitcoin starts to shine. Not because it's perfect, but because the alternative looks fragile. The real question is, will the system become more stable or less? If debt continues rising, if politics remain polarized, if central banks remain trapped between inflation and collapse, then Bitcoin doesn't need marketing. It just needs time. This matters. Bitcoin is not a guaranteed investment, a replacement for all money, a magic solution. It is a hedge against institutional failure, a check on monetary power, a signal of declining trust. Treat it as context, not a lottery ticket. History rewards understanding more than excitement. Right now, as you're watching this, the global system is highly leveraged, confidence is thin, policy tools are blunt, and credibility is fragile. Bitcoin isn't predicting collapse, it's responding to fragility. And fragility is everywhere. If this video helped you see Bitcoin and money itself differently, like this video so more people can find it, subscribe to The Finance Historian for calm historical breakdowns in a noisy financial world. And share this with someone who still thinks Bitcoin moves randomly, because it doesn't. Bitcoin rises when the system looks unstable, because instability exposes what money really is, a promise. And when promises feel fragile, people search for rules instead. Bitcoin doesn't promise, it executes, quietly, relentlessly, without fear. Thank you for watching.